Hey everyone, welcome back to the Predictive Playbook. This is the special edition, the financial edition of the Predictive Playbook, where we talk about sports betting, the markets that take place in sports betting, and why they are so similar to markets like the cryptocurrencies. And that is kind of our specialty here with my partner and co-host, Steve Merril of WagerTalk. And we've been together for we met in 1997, so I guess fair to say that we have a bit of a history here. But this is fun, and really, it's not fun because we've been right either. It's like we're showing people the similarities between the bid and ask of a marketplace and what the odds are for, say, tonight's basketball game between the Suns and the Clippers and the total. But I guess first we want to talk about Bitcoin. We're both short again. I think you said yours went yesterday. The trend following system went yesterday, which was great time. We had a big plunge this morning, and this rally is nothing more than what they call a short covering rally. Another term for our dear beloved friend, Mr. Tony Finn, also of WagerTalk. He'll be on the Manny's Irish pub show starting at 4:00. So you got to see that because we quiz him on these financial terms and his answers are nothing short of hysterical. And the guy's a modern day George Carlin. But Steve, this, I think in my opinion, and I want to see what you think too here, of course, with today's action, and I'll pull that in right here. I think this has really changed now. You and I were a little constructive last week when we were coming up into this area here, and I'm going, this is the last year. You can see my little sentiment notes there. But this is, the last several days, maybe this is about maybe a month and a half. But this is today. So we had a gap down. It opened here. And then really sold off hard. It was another cleansing, as we call it. Similar to this capitulation, but this is not a capitulation. And now we've had nothing but a short covering rally and squeeze since opening that low. What are you seeing here?
Well, a couple things jump out to me. Of course, we're talking about the Bitcoin futures contract, specifically the CME contract, which is the biggest. And of course, they don't trade on Saturdays and Sundays. The Bitcoin cash market is 24/7, 365. So normally the biggest gap you'll see on these charts is the Friday close at 5 p.m. Eastern and the reopen Sunday night at 6 p.m. Eastern, because you're talking about a good 2 full days, 49 hours basically for that market to move over the weekend. But what was interesting to me, first of all, was that the open on Sunday night was only about a $200 difference in the Friday close 2 days earlier. So that's unheard of. It could be a coincidence, but I think it was the calm before the storm. And then let's look yesterday at Monday. It closes at 5 p.m. Eastern, opens 1 hour later. So there's only a 1 hour downtime from Monday through Friday. They reset from 5 to 6 Eastern. It closes and reopens $1,300 lower between 5 and 6 o'clock Eastern last night on Monday. So 49 hours over the weekend, there's a $200 difference. 1 hour last night, there's a $1,300 difference. And obviously, it was kind of up and down after that. It treaded until about 7 this morning. Around 7, 8 a.m. Eastern is when we see this happen a lot, whether it be bonds, it's all pre-market stuff, commodities. A lot of times they really take a hard move around 8 a.m. Eastern, in my opinion. And that's when Bitcoin was off to the races to the downside. It had held steady around about 31.8, 3,200. Got as low to an intraday 29.2. It broke below that key $30,000 support level, which has been just rock solid. But guess what? It is still rock solid, John, because it bounced quickly off of that. And now it's back up to almost 33,000, the high of the day, as we do this around 3 o'clock Eastern on Tuesday, June 22nd. So I don't know. I mean, I think you might actually think that could be more downside. But once again, at least temporarily, that $30,000 support level is held so many times. And I keep saying we have to see a close below it, a daily close. It's bounced below it. Maybe that's the third time, I believe, now in the past month or so. And every time it's rocket shipped up. So we'll see if this is a short squeeze, a short cover, whatever you want to call it. But yeah, right now around 3,300, it's still in that 30 to 40 range. It broke out last week when we talked around 41, 42. I went long, and now I'm short again because it broke back down. So I personally would like to see it dip below 30, but once again, I'm not going to try to predict. I do think there's a lot of support there. However, as you know, John, with support, it holds, it holds, it holds, but when it breaks hard. So once again, 30,000 looks like the key level for me to be watching on the daily close.
Yeah, I'm with you on this, and right now we have a bullish hammer, and your point is very good, and this is something people need to remember. These are the Fibonacci retracements, the red lines going across. Just because a price breaks through it does not automatically make you more negative, and your point can't be more emphasized, because what's happening now is that, yes, you can say that that level, this Fibonacci number, held because it was not a close. And that is so important. People that are first trading and learning how to do this, I assure you, I've seen it far too many times, unfortunately, where people will put trading, orders underneath the Fibonacci, thinking that, okay, if it breaks that, then it's really gonna go down hard. And a lot of times it's because of a market like this that is a little bit illiquid. There's not a lot of volume compared to like the S&P 500 futures or crude oil. Treasury bonds are enormous. The currencies are enormous. So you can get violations of these technical levels, and then there's a subsequent recovery. My sense is that we need to see how this thing closes at 4:10 Eastern Standard Time. Because this pattern, Steve, and this is just a 5-minute window here, but I would not be surprised to see this candle turn red. And the reason that is because if you look here, we have a pretty small candle. That was our show last week. And then each candle is getting bigger and bigger. And you can see the momentum is just, it's like an avalanche. It's like looking at the Arizona Diamondbacks on a chart,
knife. It's a falling knife, right?
It is a falling knife.
Yeah.
And this is just my opinion right now in a 5-minute window. So I could have egg on my face within the next 15 minutes, but I just have a funny suspicion here that this short covering rally is going to be met with some aggressive selling here in the last hour of trade. And Steve, let's take a look at the S&P, because during the pandemic, these traded basically in parallel, meaning that if the market was up, then Bitcoin was following. And now you can see we have disjointed ourselves, disconnected between the currency, the Bitcoin, Ethereum, whatever you're looking at. And you can see we went down hard on Friday, but then we didn't have any follow through. And this is a very common occurrence. You have a big sell off. No news over the weekend, that would cause concern. No follow through, and then all of a sudden there's a short covering squeeze again. And now we're on the high of the day, but Bitcoin chart looks a little different, doesn't it? Even the same indicator here, way different. So there's a big disconnect between the two, and I think that also is going to weigh on Bitcoin, because people are going to get out of Bitcoin. What are they going to do? They see this going up. Real estate going up in the East and basically everywhere. Why am I in Bitcoin? I'm going to sell it and get into stocks. Yeah. So I think there's still more to go on this crypto before we actually get a great buying opportunity.
Yeah, I mean, and keep in mind, whether it's the S&P or whether it's Bitcoin, whether it's corn futures, there's a buyer for every seller. I say that every episode, because that is the one big difference between the sports betting markets and the financial and the trading markets, is that it's a zero-sum game. Sports betting, you could still have very heavy one-sided action. Sportsbooks don't always have a balanced game-to-game. That's why the lines move. But you still have that same element within these markets. And the whole reason prices move, while there's a buyer and seller for every commodity, every stock, every whatever, every crypto, the prices still move because of the imbalances. The market's just a lot better than a sportsbook as far as equaling things out, because it's zero-sum. So it's all about buying pressure and selling pressure. And by the way, to get back to your point about those stops, it's not a coincidence, by the way, you see these hard moves at these like key levels like 30 and it keeps bouncing, because whether you believe in technicals or not, or Fibonacci's or not, whatever, it's a self-fulfilling prophecy, because so many people do use them now, whether they work because everyone's using them. And the sharps out there, because there's sharps in the sports betting markets and there's sharps obviously in the financial trading markets and the poker tables. What's the old saying? After 15 minutes of the poker game, if you don't know who the square is, you're the square or you're the patsy.
Exactly.
That's one of my favorite sayings ever in life.
Yep.
And it's the same thing here. There's a lot of people that use these support resistance levels. So the sharps out there are triggering their stops. And it's another good word for Tony Finn is triggering a stop loss. Man, he could run with that one, John. But
yeah, that would be another half hour.
Yeah, there's a half hour gone by right there, triggering your stop loss, Tony Finn. But yeah, because people know 30 is a keyword. So like you said, John, you don't put your stop loss at 30. And that's why the daily close is so important, because anybody can be a tough guy in a 5 or 10 minute channel, and trigger somebody in or out. But these daily closes have yet to go below 30 since January, basically. But even then, you got to be careful, because what I'm talking about, people know, and they can still. It's still just a 1 hour window before it reopens again. But the other reason too is I don't know about Bitcoin, but I know with like the stock market, like the S&P, for example, since we're on that, the closing price is just like in sports betting. The opening line is soft. The limits are lower because there's a lot of unknown information on Sunday night, 6.5 days before the NFL games with injuries and whatnot. As the week goes on, the money starts to balance it out. The information becomes known. The closing line on an NFL game on Sunday a week later is the most accurate number. Same with the NBA, because if LeBron James is not playing, the line moves 4 to 8 points, and it closes at a much different number than the opening line. So I know when you do your research, you don't necessarily look at closing lines. Like I think Ralph Michaels, a great database guy at WagerTalk.com with this, is he looks at like kind of the consensus number in the middle of the day, and I really like that because that's the bettable number that most people can get. But obviously that can move as well. But when in doubt, you want to use the closing line versus the opening line when doing your research for sports betting, because it's the true number, even though that maybe wasn't widely available for more than 10 minutes. Same thing with with financials, though. And my point is that the closing price is the greatest truth, because the entire day's activities are taken into account. Like you said, you don't want to be long or short over maybe an entire weekend. So like the Friday, and you can also look at weekly closes. The weekly close is the best one. I don't like using that as much now just because things move so fast. When you and I first knew each other back in 1997, the weeklies moved better because it was costing you $50 to $100 to get in and out of commodity trade, so you couldn't afford to trade on a daily basis. It would eat up all your capital. With these free day trading accounts, people trade for free now. So I'm a little apprehensive to hold on a weekly basis on a weekly bar. But the weekly close is something you want to look at along with the daily close. And something we haven't talked about, just big picture, is like I like to look at 1 hour, 4 hour, 1 day, 1 week, bars. And what you want to look for is multiple support resistance levels. Like if you find one that the 1 day and the 1 week, if they both coincide like on 30,000, that's really powerful stuff, because when it breaks, all those people, whether they're daily or weekly traders, are all going to be getting out. And it can really, there again, if everyone is selling, if everyone's hitting their stop losses, it's gonna drop 5,000-10,000 more just by default.
That's true. And this is a daily bar that we've been looking at. I actually look next at a 4 hour bar, which is right here. And you can see that this gives you a little bit different picture of today too. That's an engulfing candle, and it's a 4 hour. Now, if we would get follow through, my statement 5 minutes ago would be wrong for 2 hours. It doesn't mean that prices aren't going to revert back to the sell side, tomorrow, Thursday, or Friday. But I had lumber up. Well, before we do that, let's show the difference here for those that have never seen it. This is a 30-minute bar, and today has actually formed an inverted head and shoulders like that. You can see the head right here, shoulder. And the shorter the time period, the less reliable the pattern becomes. Steve said the weeklies, if you get a head and shoulders like this and it's a weekly bar, it's very powerful, very reliable, and should be paid attention to. But 30-day, this is the type of pattern where people tried to day trade and just got chopped up. You get whipsawed, another Tony Finn term that he has no clue what that means. Yet, we are educators, Steve. But this is somewhat constructed. But again, if I take this right here, we have all this short coming. Now we're starting to, you can see the momentum. You can just see the momentum kind of like, it's just kind of like, It's like the Arizona Diamondbacks again. They score 7 runs and then they just know in the last 2 innings it's not going to work out that well. But they are on a 1-game winning streak.
Yeah,
And
which
then, of
broke
course,
just for the non-sports people out there, which just broke, what was it, John? A 17-game losing streak? And
17-game consecutive losing streak. And that does happen in the markets too. We can have 17-day losing streaks in currencies, commodities, stocks, Apple. It's happened. So again, it's a similarity in many parts of our lives, not just these two.
And by the way, real quickly on that is, and for those people that are like, they can't possibly lose 12 in a row. The market can't be down for 13 straight days or 14 straight days or 15 straight days. You've gone 1 in 5 until you were finally right. So that's exactly why you don't try to catch that falling knife, as we always say.
Nope. And this is a 5-minute bar. So it's the same data shown a different way. And again, you can see how it's rolling over a little bit. And, you would never in a million years say that that's an engulfing candle right there on a 5-minute bar and then go short. I mean, that's you may be right a couple times, but over time, you're going to get chopped up like, something in a blender.
It's like a lot of it's just random noise. It's like watching these NBA games. What do you think, and most people can answer this as sports fans. What do you think is more telling in an NBA game? A 5-minute sample when a team goes on a 10-0 run, or a 30-minute sample, or a 10-game sample? It's obviously the noise cancels out the longer sample size, just like the systems you use. Your systems on NBA tip-off on WagerTalk TV. Obviously, you want to see a 50 or 100-game sample versus a 10-game sample. So, yeah, the longer time frames are always better, and the weekly, very powerful stuff, like you said on the weekly charts when you pay attention to them.
And this, of course, is a 1 minute, so it really can show you how active it is. So yeah, you can do any type of time period, but I think the longer, like Steve said, the better. You start with the daily, look at the weeklies. I even sometimes look at monthlies on the S&P 500 because historically there's been engulfing candles at the top of just about all the way back to 87 of the major financial declines. The story was told before you heard about it on CNBC and CNN. The warning signs were there. It's not like some magic. All of a sudden the big boys started to sell one day because of a news item about Bear Stearns or something. It was there. The story was being told before it was reported. I guess that's the way to say it.
What's fascinating too is that the bond markets. Something I hadn't mentioned to you, which I'm sure you're aware of, is the I track the 2-year, the 5-year, the 10-year, and the 30-year notes, bills, bonds, different terms for the time frames. But normally they move the same. They might be off a little bit. But the Fed spoke last week, and they basically said they're not going to do anything until 2023, and everything jumped temporarily. But what's fascinating to me, John, and I have not seen this in a while since I've been following it, at least for the last few years, the 2-year Treasury dropped hard. Meaning, its rate rose. It's an inverse. When the bars drop, the rates are rising. So I'll put it in layman's terms. The interest rate of the 2-year jumped higher, the 5-year higher, the 10-year less high, the 30-year barely moved. And it's still been that way for about a week now. So there was a real divide between the 2 and 5-year short term versus the 10 and 30-year bonds, note and bond. And so that's something else to keep an eye on. I mean, the bond market is the sharpest market. It's the biggest, as you said. Other than the currency markets, it's the biggest. And it's the most boring. Nobody talks about it. It's not exciting like Bitcoin. Bitcoin would be like a Ferrari or a NASCAR. The bond market would be like a jalopy or a Yugo. Would be the best analogy as far as excitement.
But there are times, though, that it is the Ferrari. Like
it is, yeah. That's a good point.
It flight to quality situations like we've seen in the past. And, when you play the 30-year bond, every single tick is $31.25 per contract. And this is the 2-year note, which I brought up while Steve was talking about it. So you can see price got hammered.
Right. So when those big reds dropped, interest rate went higher, just so people realize it's counterintuitive.
Yep.
Right.
That was anticipating a Fed decision, or this reaction here is the lack thereof, because it was very disappointing that they did not say they were going to raise interest rates, because the inflationary pressures are quite evident. lumber, which I had up earlier, had like 5 days in a row of gap down, which if you were long, you were absolutely financially destroyed, even if you owned a couple contracts, because you could not get out.
Exactly. Yeah. It's a fun situation. Now you know why there's only about 100 contracts traded per day in that market.
So now we have the Australian dollar here, and I'll see if I can pull this up here.
Yeah, and all the currencies have been dropping pretty hard, as you know, like in even like the yen and non-correlated ones have all been dropping the last couple weeks. But keep in mind, the currencies have been on a run straight up for about 6 months. Commodities have been on a run. Yep. This goes back to your point. What made me think about the bonds and the notes is what you said about the market's always ahead of the game before people are talking about it. You and I, we don't do a lot of fundamental handicapping in the markets, but you and I both for months have been saying inflation is inevitable. Just if you just look at it from an economic perspective, you can't keep giving everybody money and printing money and things not cost more. It's just the dollar's been decimated for that reason. The foreign currencies are going higher when the dollar goes lower, but it's usually ahead of the game. And now everybody the last couple of months has been talking about inflation. And guess what? Like you said, lumber almost down 50 to 100% from where it was in March. It was 800, 1,600. Now it's like 900. So like the public is always late to the party, whether it be sports betting or, the financials. And the fact that the 10-year note is actually, the interest rate continues to drop on that the last few weeks would be telling you inflation's not here as much as people think. And I think that's already been priced into a lot of stuff. So I was Mr. Inflation for the last 6 to 8 months. I'm actually less so now just because everyone else is now talking about it. So it's funny how that works. It's almost like a fade the public like I do in the NFL. You want to fade the public as well, whether it be financials or sports markets.
And this is a weekly of the Australian dollar. And the currencies, I would have to say, are in my wheelhouse. It's like the NFL.
Right.
And you can see that this is the beginning of the pandemic right here. And the Aussie traded 1.08. Here it's 0.55. So it lost half its value from 3 years earlier to this point. And then we started to get this. And then all of a sudden we start getting news right in here of a stimulus. And it's gone up here. But then again, here's another casebook example of an engulfing candle. New high, failed, closed below the previous day's low. That is a sea change. There's no ifs, ands, or buts about it. But I think what you're going to see here is a continuation pattern unfold right through here. May dip down maybe as low as 72, 71.50 in this area, and then it'll resume its trend higher. And after all, it's only halfway back to what it lost 3 years ago. And the reason we pull up these is because the Aussie and the New Zealand and Canadian, and to a certain degree, the Japanese yen are all commodity-based currencies. So they're going to reflect the inflationary tendencies on a macroeconomic level better than anything else that I'm aware of. So real quick here, this is the Kiwi or the New Zealand dollar, but Kiwi sounds cooler. So what do I have here? Do I actually have this up? Yeah.
I've actually got this, John. Let me ask you real quick. So I only trade the Aussie because, from my research, the New Zealand dollar is like, 90% correlated probably. So, do you ever see a reason to trade them both? When would one of them diverge from the other from your experience?
Only if their economic policies are differing. In other words, if their version of the Federal Reserve, say New Zealand is holding interest rates constant, and their rates are higher than in Australia, but Australia now is starting to raise their rates. That's going to make the Aussie currency more attractive to the New Zealand, which is going to cause that arbitrage to widen. And I have traded that over the years.
So you think they're going to be a little less correlated going forward in the next year or so?
Well, they're always correlated, but there's always an opportunity to see profit to trade. I think I can actually maybe bring it up quickly here.
Because over the last few years, the charts have been almost identical. Although, like you said, most of the Forex charts have been identical, whether it be the Canadian. The yen has been the one that's been very different than all the other ones over the past year. The yen has actually dropped a lot while the others were rising, from what I noticed. And by the way, for the viewers and listeners, the euro is basically a 100% inverse of the dollar. So if you're unable to play the dollar in the futures markets, the FXE is an ETF, which is the euro, and you're basically getting the exact inverse, 100% inverse of the dollar. So if the FXE continues to go up like it's been doing over the past year, that means the dollar's been dropping. So anybody that wants to, play against, thinks the dollar is dropping, you would buy the FXE. The problem, of course, is that the ETFs, you can short them, but it gets a little pricey and it's not optimal. And they also, the CME, once again, we got to get a sponsorship from the CME, John, because we're promoting them so much with these future contracts. But they offer microcurrency contracts now, and they used to do the E-mini. They even do micro S&P, and they actually do I forgot to mention this. I'm not sure I think I've mentioned it once maybe. Just as a couple months ago, they now do a micro Bitcoin contract, which is 1/10 of one Bitcoin. That's 1/50th of a normal Bitcoin contract. Because keep in mind, the normal Bitcoin contract is 5 Bitcoins on the CME exchange. And that's why it's so expensive and it can be so crazy margin-wise. So you're getting a contract 1/50th the size of that, just 1/10 of a Bitcoin. So instead of a $30,000 coin, you're having a $3,000 coin. So when it moved 2,000 today or 3,000, you only missed $200-300. So everybody can afford to play now in the future markets with the CME exchange. We're going to send this podcast over to them. Let's get some sponsorship from them because
I think so.
Some good plugs. But they have the microcurrencies too.
It does make it easy because I guess that would be a $600 difference. With say Bitcoin's at 30,000,
right?
150 would be a $600, and that's monumentally different. And that's going to provide liquidity and more players into the market, and that's a positive.
Yeah, and here's the other thing to think of, too, on that real quick to put that in perspective. The average true range over the last month or two has been about $4,000 a day from high to low is what you can expect Bitcoin to move. Now, that's on an average day. I would recommend from a risk parameter to multiply it by 3. That's what I personally do. So when I'm looking at a risk parameter for my markets, for my trend following method, I basically takes it times 3 and that actually works pretty well because look at the what was it, the 4 Wednesdays ago we were on here, May 19th or whatever. It was like a $12,000 or $13,000 move that day. That is about 3 times 4,000. So put that in perspective. One Bitcoin is going to move on average 4,000. You're getting 5 in a normal contract. So that's a $20,000 swing on average. That crazy day was a $65,000 swing on one contract. So now you're getting 1/50th of that. So it's only $400 per coin. So you're only talking about like a $400 to $1,000 swing that would be a really bad day for you with the micro contract. So it's going to enable a lot of people to manage their money better.
Yep.
And instead of holding these coins in these e-wallets and stuff, people really should consider the futures markets. I know they get a little intimidating, and John and I could probably do a video. If there's enough interest out there, message us, leave a comment below on YouTube, and let us know. Maybe we'll do a video on it one day on how to get involved in the futures markets. But yeah, the CME has a lot of micro contracts, whether it be the indexes or the currencies, which is kind of what made me think about it, where everybody can play now and not have a lot at risk.
And this is a chart of the Aussie-New Zealand cross. So you can see that the volatility between two similar economies can be pretty significant. So you have 110 to 104. That's essentially $6,000 per contract in the futures market. So every 01 is $10 per contract. So there are opportunities that are pretty well defined, especially a rare situation where their monetary reserves are either one's stable and one's tightening interest rates, which means they're tightening fiscal or tightening monetary policy, which leads to higher interest rates, less money supply, slows down inflation, slows down the economy, versus one that has the spigot wide open and kind of like we have here in the United States. There's money sloshing around, and that's one reason why we're at all-time highs in the stock market, and housing is booming, but for the right reasons. So it's again, I always come back to the story's always there. It's right in front of you on that chart. We always look at Endeavor too, which is the UFC, because that is obviously a stock. It's sports related. And this just went public, back here, that many days, like 3-4 weeks. I don't even know if that's a month yet, but it's been very stable for an IPO. it made a run up here to 33. Now it's back down to 20. What is that? 26 and change. But I kind of like how this is trading. It's not setting up for quite a buying opportunity yet, but fundamentally, Warren Buffett always says, if you like the story, you stay with the stock, and that's one way to define it. If you still like going to McDonald's and you own McDonald's and you like it and they change the menu and you like it even more, that's a reason to stay with it fundamentally. And UFC, you have to think that's probably the most rapidly growing sport on the planet right now. It's a lot different than the growth that the NASCAR franchises had the benefit of in the early 90s. And it's sustainable for the UFC, absolutely sustainable. The quality of the fights and entertainment is really, really great. So how we look at this. Is there any stock you want to look at, Steve?
Well, just on UFC real quick, everything you look at, you want to be like, if we have another pandemic, another black swan event like this, it'll be different next time, but it'll rhyme. They usually rhyme, although they're different. UFC was, along with NASCAR, like you said, were the first two to come back, and they still competed. So the pandemic actually might help them a little bit as far as having, an audience and having a contest, having the event still. So, but once again, with any of these stocks, one of the reasons I don't do a lot with individual stocks is just because as a trend follower, it works. You can trend follow stocks, anything you want, but the key to trend following is diversification and non-correlated assets. And what drives me crazy, we could do a whole episode on financial advisors. And by the way, I think they serve a role for most people because they keep them out of their own way. And being long, by the way, the S&P or being long any stock over 10 or 20 years does have an expected value, because a positive expectation, because the S&P, what people don't realize is that it's basically a default trend following. It's a slow-moving trend following mechanism because it always has the top 500 companies. The underperformers are dropped, and it's top-heavy to the top performers. What was it a few months ago, John? What was it, like 5 stocks made up like 20% of the S&P 500?
Right.
That's trend following. So it cracks me up that people who are just buy and hold, which I'm not a big believer in, it works because they're actually doing a trend following method. Now, you can get into the argument whether stock picking works, and about 80% of all advisors underperform the S&P index, which you could own for free nowadays. But once again, most advisors are worth that 1% to 2% cut because they keep people from making mistakes that they would make. You and I don't need that because we know what we're doing and we can do it on our own. And we're trying to educate the listeners and viewers here to do it on their own as well. But the problem, what cracks me up real quickly about, financial advisors is they say how diversification is the key. And they're right, it is the key. But they're not diversified. They own one asset class. They own stocks. And they only own one country. They own mostly U.S. stocks, which is makes up less than half of all the stocks in the world. And then on top of that, they own 40 different stocks, and they think that's diversified, even though those stocks are probably 90% correlated. And March of last year is a perfect example of that. There was no reason for Clorox or any of these companies to drop initially, but they all plummeted. Right. Because first of all, there's panic. And second of all, you could have the best company in the world, but if someone has to get out of another position, they got to sell their good positions to get cash. So you got to be very careful with stocks. And you could any of these companies like DraftKings or UFC, but the problem is it's not their fault they drop sometimes. It's because other companies are pulling them down with them. So that's why I kind of stay away from the individual stocks. But, in hindsight, as a handicapper, we should have been all over Clorox, Netflix, Amazon, because they benefited from the shutdown, But they all took a plummet at one point, And yes, they were great buying opportunities, but stocks are tricky because they're all kind of correlated and dependent on each other, and the market is not diversified. So beware out there. If you're with a financial advisor and you hold nothing but 70% stocks, 30% bonds, you are not diversified. You will make money over the next 30 years, but you're going to have some nasty swings in the meantime.
It can be very upsetting. And as we can see here, the amount of the hammer on Bitcoin here is declining. So we're almost back to the opening, and we got another half hour to go.
Yeah, it's another.
What I'm seeing.
Yeah, this is the third time we have seen this where we've had a hard intraday low, which bounced right off of it and never went lower. What I will point out about the three of them, though, the first one was back on May 19th, as I mentioned, that Wednesday. The low of the day was 30,300, 275, 30,200. And then it took about a couple weeks later on June 8th. The low of the day was 30,900, a teeny bit higher. The low today, though, was well below those, 28,800. So lower lows and higher highs is also kind of a long-term trend following method. You can just look at it on charts.
Yep.
And I think short term, this could be a little bounce off of this, John, but it's creeping lower and lower below that 30,000. And for the first time today, it did break that 30,000 since the beginning of the year. And isn't it ironic that 30,000 was like exactly where it closed in 2020? Then we went up to 62, and now we're back. So, I've been saying this for weeks, and you've been agreeing that, 30,000 is a hell of a support level.
Yeah, it is.
And I would keep an eye on it. It keeps testing it. And, if you jump up and down on the floor enough times, it'll only hold you 3 or 4 times until it breaks. And when it breaks, you fall several stories. I just made that one up, by the way. That's my new analogy. I'm going to copyright that one.
That's good.
It is good. I honestly just made that up.
That's good. Now, I'll ask you this simple question, and then maybe we can use it to lead to the end of the show.
Sounds good.
Would you, looking at this picture, and put yourself in the the new investor generation? You're about 26 years old. You've had the emotional roller coaster of Bitcoin, thinking it was going to 200,000. Now you're long from, say, 15,000, and now it's like, oh my goodness, do I protect my gains or stay with it? Would you rather buy that chart, or would you rather buy this chart, where probably 4 or 5 to 10 items that you own are from this company called Apple? So my demographic theory is that the younger generation that's coming into investing now, that was all over Bitcoin, and it was new, exciting, and was going to replace so many other things, now has begun to fail pretty miserably. But I'm not saying it's going to fail miserably long term. Just saying the emotional roller coaster ride right now is certainly on the negative side for Bitcoin. And then you look at this and you go, well, why didn't I just stick with Apple all along?
Yeah,
but that's kind of like what you're seeing from a behavioral standpoint, and we see this in betting all the time. I run those pie charts that some of you have seen on the Manny show, which is a Python program going into like 1,100 tweets, and the Sixers hashtag is here they come. And they achieved an all-time low for negative sentiment, which then turned into a buying opportunity in game 2 and a buying opportunity in game 6. It then went complete reversal to too many excited people for game 7, and we all know what happened. But there's no city that I've seen so far with that program that I run, the tool, that has the swings to Philadelphia, and I'll include New York. New York is very, one day to the next can be, fire the coach to he's in the Hall of Fame. But we see the same thing in the stock market too, and this is a perfect example with Bitcoin and Apple.
Yeah, and think about it too. I keep talking about zero sum, and the buyers and sellers have to balance, but if everyone is negative, it works even better in the financial markets, because if everybody is negative on something, then that means there's no sellers left because they've already sold. So that's why I think sentiment is so important in the financials. And the all-time high in like 2007 of September, and then the all-time low sentiment was like March of 2009, which is the lowest the market hit after that 10 or 15 month run, or the 2-year rundown there. It was just incredible. 2007 high was the all-time epitome of excitement, and it was the worst time ever. It was basically the peak. And then nobody wanted anything to do in 2009, and lo and behold, it never went lower because there are no sellers left. And just big picture, too, something to think about Apple is that it's owned by so many investment funds and mutual funds and long-term, funds. There's no sellers there either because people are holding it in retirement accounts. Bitcoin is just a trading device. It's an intraday trading device. And also just look at the rollover. Yeah, and you look at Bitcoin, it's rolled over. The moving average is a downward slope now. Apple's the exact opposite. It looks like a smiley face, like it's curving up. And that's another way, looking at the trend is very simple. You can just put a moving average on it, just look which way it's sloping, and that tells you what the trend is. And right now, the Bitcoin trend has been down for several months. We've been short almost 90-95% of the time during that. And it might go up, it might not, but I definitely would not tell somebody to run out and buy right now. It's definitely got some downward momentum still.
Yeah, and with my sentiment readings on Bitcoin, at the top, it was running in the mid 80s, which is extraordinarily high. Too many bulls, just too many bulls thinking it was going higher. Now we actually just dipped below 30 on that sentiment scale, which is going to eventually be supportive for a bottom and a I think what'll be a terrific buying opportunity. The fact of the matter is we don't know where that bottom is. It could be happening today. It could be happening at 14,000. It could be, we just don't know. And that's why it's so important you let each day be a chapter of your book and it tells the story. And you just have to be open and honest with yourself of what that story is telling you. And it really doesn't become that difficult to do.
Yeah, the biggest mistake I think most investors make, and I'll say right now, is what is your exit plan? I mean, most people don't even have a buy plan. They just buy. I have a specific number where I'm long or short. And I just rolled over from long to short again yesterday. And I have another number where I'll be exactly long again. I'm always either long or short. I'm active. I'm a trader. I'm not an investor. I'm a trader. I'm either long or short all these. That's my trend following method in all these markets. But I would say 90% of these young novice investors, new investors, if you go, what's your exit plan? They don't have one. And that's fine and all 90% of the time until like that Wednesday morning a few weeks ago that we referenced when it dropped $10,000, $13,000 in 15 minutes or $5,000 in 15 minutes, $13,000 for the day. That's not when you want to try to be making rational decisions at 8:50 a.m. when you just lost $5,000 in 5 minutes on a contract. So on a Bitcoin, it was actually probably $25,000 on a contract. So it's even more. It's even more on 5 Bitcoins. But yeah,
it's dangerous stuff. I mean, it's more dangerous than betting on a game tonight.
Well, it's in-game betting because if you bet on a game tonight, it's done. Like right now, if you take -3 or +3 on a game, you're 100% in and you're done. And the new equivalent to this is the in-game betting. You make a bet, you can make another, but you can make 50 or 100 in-game bets if you wanted to. And that's when people get in over their head and they start chasing. And just have a game plan. And like I said, if you're going to buy Bitcoin, that's fine. When do you get out? Do you ride it to zero? I'm not saying it's going to go to zero because I don't think it will, but it's like the Diamondbacks. Say a good analogy would be like the Diamondbacks. That's a falling knife. They lost 17 in a row until they finally won last night. Let's say 3 weeks ago, you said, I think they're going to be a hot team. I'm going to bet them every game. Like at some point you were wrong when they lost 5 or 10 in a row. At what point do you stop your system? Well, they can't lose 11. I'll bet them one more time. They can't lose 12. No, they can't lose 13. So it's like you don't want to be making those decisions when it's happening because that's not when you have your clear thinking. And you and I as handicappers know that. I mean, you want to look at stuff ahead of time. You look at your numbers. You look at the matchups. You don't want to be making like a harsh, fast, emotional decision. That's just never the way to do it.
Yeah, I agree. And this is crude oil. I guess this will be our last chart. This is a trade that I'm looking at very closely to short. And as you saw on the previous chart, when it was much longer, it basically has rallied since the pandemic started. Slowly at first, but then more and more and more. And it's not because of inflation entirely. It was just because of supply and demand. The pandemic stopped everything. There was zero demand for heating oil, zero demand for unleaded gas. And as a result, those two products and jet fuel are made from crude oil, along with kerosene and a bunch of other things. But now it's really stretched and the trend has matured, and there's going to be some type of correction. I don't know if it's going to be like a sea change, but I think it's going to be some type of correction where it's 73 and it goes down to some level. And that's why the Fibonacci's are so important, because it gives you an idea of what the potential decline could be. So I'll try to tweet this if I get the confirmation, Steve, on the short. But again, you have a big rally now, no follow through, absolutely zero follow through, and it's, if anything, it's a doji, which is another turning point.
Yeah, I'd say
So
both 60 and 70 to me, just looking at it now, look like a lot of support levels. 60 is pretty far down, but you had a pretty big jump back in late February from 60 all the way up to 70, and then it came right back down to 60 for like about a month, and then it just broke above 70 again about a month ago. So I would see it going all the way down to 70 probably, and then maybe 65 or so in the middle of that channel. But and then 60 would look like some really long-term support. But
yeah, I agree with the
yeah.
60 for sure. 60, 62 is, yep. And we'll take one last look at Bitcoin. Huh. Oh, I have two slashes in there. There we go. Yeah, so it looks like it has the chance to close as a little bit of a hammer. But I might, until action would get above this yesterday's high, I'm not too excited about it.
Yeah, and just to put things in perspective, if you're looking at like the weekly close, I'm looking at like the 6 weeks. The lowest close we've had has been 36, 35, 36, 35, and now we're sitting at 32. So I mean, this is several thousand below a weekly close. You have to go all the way back to beginning of the year, basically. In fact, the last time it closed below this was in December. It closed at 30,700 the last week of December. Now it's only 32 now, but every close since then has been like mid 30s or higher. So,
and this is your weekly chart right here.
Yeah, the weekly bar. So if you look at that, where we are right now is several thousand below any close since December. So it's going to have to rally, John, a couple $1,000s over the next 3 days for us not to have a 6-month low weekly close. And there's a lot of trend followers out there that I don't use this method. They use breakouts where you have an extreme close over a several month period. So that by itself would make me think either on the closed Friday or more likely on the open Sunday, it'll drop even a little bit more just initially, and we'll see if there's any follow through. But this is what we're talking about. I mean, maybe it hasn't broken through that 30, but we're on a 6-month weekly low right now for a close, and yeah, I think that's not a good sign.
And this chart is the same instrument, and it's weekly bars, and it tells you an even more bearish story because you have the inverted hammer closing on the low on Friday, and now we have this hammer developing, which if we don't take out the opening of the week, that was Monday right here, is going to be more bearish news. And these type of candles, you get a retest of these lows. And we're at a level.
Look at those two big gaps over in the middle of the chart, the 3 green candles. We're filling that first gap, but then look, there's another gap right below that, which is probably, that was probably what, late November, early December. Remember, it went from like 10 to 20 within weeks, and we've never filled that gap. And gaps usually fill, and not always. Isn't that something?
The adage.
Who would have thought when it was 62,000 we'd be back filling the 20,000 gap?
But you can see the excesses and with the indicator down here, and then the bearish divergences, and then you finally get the peak. Another good pattern right there, and now we're getting to the point where we're going to start developing over the next 4 to 8 week period. Like I said, the potential for a significant major bottom, but we don't know where that is.
I think it'll be that 20. 20 was the all-time high back in 4 years ago, 5 years ago, when they started futures contracts. And the day the CME started trading a futures contract like 4.5 years ago, the day it opened, it never ticked above the opening price of like 19 or 20,000, whatever it was. And it went as low as like 6,000 at one point. And then we finally got back to 20 last November, closed at 30 for the year. So wouldn't 20 make a lot of sense? I mean, it would basically flush out all the new people over the 6 months
right
or
here.
So. Right, and it's
that's the 78.6% retracement on the Fibonacci chart.
That's about the most extreme you can get. Yeah, that's like the most extreme you're going to get, and that's exactly where it all started. And that's what lumber has basically done. Lumber and Bitcoin are like my 2 big inflation plays the last 6 months, and now they're recorrecting. And the 10-year note is the interest rate is dropping on the 10-year. So, I mean, I really, and now everyone's talking about inflation. Nobody was talking about it 6 months ago when you and I were. Now everyone is talking about it. The media is talking about it. The Biden administration might have actually even eventually start talking about it. That would be the capitulation, by the way.
I would agree.
They've denied it from the start. And yet all the markets where the real smart money is not talking about it. Pretty interesting.
The markets tell the story, and I've always said, and this is 2 decades on Wall Street, the most powerful person in the world is the Federal Reserve Chief of the United States.
Yep, exactly right.
And they control the money supply. They control, the cost of a paper clip.
His words move markets.
Control everything.
His words move markets, unlike Elon Musk.
Yep.
Even you're exactly right about that. I've said that ever since Greenspan. I first noticed that back when I started following this stuff 20-some years ago. I said that to so many people, and I've never heard anybody repeat it. I said Alan Greenspan is the most powerful person in the world because he can move markets by talking. It's insane.
And I still use his most famous speech in '98 that he felt the stock market was showing signs of irrational exuberance.
Yep.
And I use that in sports betting. If you ever bought any of my subscriptions and you're following us here, you know that I've said that the betting community is showing irrational exuberance on Team A.
Yeah.
And that probably applies to the Diamondbacks right now because they're in that situation where even the worst teams in the history of baseball go on winning streaks.
Yeah, but you know what happens, John, and I'd love to do some research with you on this sometime, is it's not always the next game because if anything, they're celebrating tonight like they won the division and there's a hangover. And the team that just lost them is like, we're not losing to that team a second time. But I bet you that if you blindly play the Diamondbacks starting tomorrow, let's go back and track this. Tomorrow is Wednesday, June 23rd. I haven't even looked at the schedule. I don't even know who they're playing. I will say the Diamondbacks over the next 10, definitely the next 20 games are plus money. So we'll have that on record here.
At least.
Yeah. But probably lose tonight, though. But the next 20 games. Give me the next 20 games, and I'm not going to take tonight. They might win tonight, but I won't count it if they do. I want the next 20 games starting on Wednesday, June 23rd. And I think they'll be up money.
Yep, I agree 100%.
Not a bad little system. And if you're a sharp bettor and you have like 5 different sports books, you're going to get the best price on every game, you'll definitely be up. But we'll just take the consensus line.
That'll help a lot.
We'll go back and check it in your database just using like the consensus line.
Yep.
So game 1 will be June 23rd for the record.
Got it. Well, Steve, I'm going to get set here for the Manny's Pub show that you come on Friday afternoons, and we love having you come on Friday afternoon. I said there when you were getting Finn all riled up that you were sticking me with the problem child.
Then I leave you all.
So, and then you leave
for bedtime.
Yeah, we took care of them.
That was funny.
Yeah.
I'll try to do it again this week.
that would be very much welcomed.
Sounds good.
Very much welcomed. I love it because you have a little bit more guts with me. Like Finn, what's a short squeeze? When you get to know Finn, if you don't know Finn, those are questions that require a really strong friendship between the two.
Yeah,
I guess that's fair to say.
I'll bring on a couple this Friday, and I'll throw them at him. I'll think of some good ones.
Yeah, there's a ton of them. Yeah, all the option stuff.
I want to ask him, actually, oil. I knew there was something we just did. That's what gave me the idea. I want to ask him the difference between crude oil and light sweet Texas light sweet crude light sweet.
Well, ask him the difference between Brent.
Yeah.
Brent North Sea oil. Well, we don't even say North Sea. Just ask him what the difference between Brent and WTI.
WTI. Oh God, can you? Yeah, we'll just ask.
That would be the technical way to say it.
West Texas Intermediate, and I know he's not listening, so I didn't give it away to him. But it'll be WagerTalk International or something creative he'll come up with.
Yep, it'll be or something.
All right, man. Say hi to the boys for me.
You will. I will. Yeah, this is my going on my 8th show, so I'm starting to get a little wacky, but I'll make it.
Sounds good.
Thanks for being on, Steve. We'll catch you on Friday.
Thanks, John.
So we got to end the show the right way. I can't do it without it. So for sportsmemo.com, wagertalk.com, Steve, Merril, and myself, may all the wins be yours.